All right, let's dive right into this explainer and unpack Rockwell Automation's Q2 2026 financial performance. Today, we're really going to look under the hood, peeling the onion, so to speak, to see exactly what is driving their incredible numbers right now. Look, if you're keeping tabs on the industrial automation space, this is absolutely a company worth your time. And by the end of this, you're going to understand exactly why.
Here's how we're going to break it down today. First, we'll look at that massive Q2 headline financial beat. Second, the specific drivers of their margin expansion. Third, how they're dominating strategic market segments. Fourth, we'll dive into software and intelligent devices. And finally, number 5, we'll look at their upgraded FY26 outlook.
Okay, kicking things off with part 1, the Q2 2026 headline financial beat.
$3.30. That right there is the Q2 adjusted EPS, and it was a massive beat, driven by double-digit year-over-year growth across the board. Orders, sales, earnings, the whole shebang. It's a huge testament to their strong market position, especially led by really robust demand over North America. Make no mistake, this isn't just some minor incremental win we're talking about. This is a highly significant operational achievement.
What's really fascinating here is just how broad-based this beat actually was. I mean, reported sales were up 12%, with organic growth sitting nicely at 9%. But you've got to look at that third point, an incredible 17% jump in software and control organic sales. That was driven largely by double-digit growth in their Logix platforms. Add to that a book-to-bill ratio of 1.07 in their lifecycle services, which, by the way, is slightly higher than their historical average, and it tells you a great story. They aren't just executing today, their demand pipeline for tomorrow remains incredibly solid.
Which brings us right to section 2, the actual drivers behind this margin expansion. You really have to ask yourself, how on earth did their enterprise operating margins hit a record 22.5%? And remember, they recently had to start including corporate expenses in this metric due to SEC requirements, yet they still delivered that massive 22.5% figure. So how did they pull that off despite such a complex, dynamic, global supply chain environment?
Well, CFO Christian Roth laid it all out on their earnings call. He pointed to higher volumes, positive price-to-cost execution, and a very favorable product mix. And this perfectly illustrates the company's sheer pricing power, not to mention their ability to effectively manage cost inflation. Sure, they're seeing higher volumes, but that positive price-to-cost execution, combined with a really favorable product mix, those are the real heroes here, all backed up by their relentless internal productivity.
So the real takeaway for you as an investor is that Rockwell is successfully passing those costs along. They're actually expecting 250 basis points of total price realization for fiscal 2026. Break that down, and it includes 150 basis points of underlying pricing just to offset general inflation, things like fuel, alongside 100 basis points of tariff-based price actions. They aren't just taking these inflationary hits on the chin, they're strategically managing them.
And, the proof is absolutely in the pudding. Gross margins expanded year over year by 160 basis points to cross that massive 50% threshold. This kind of top-tier margin expansion proves Rockwell isn't just selling more stuff. They are fundamentally operating way more efficiently. In fact, their incremental margins on year-over-year sales growth hit the low 50s in Q2. That is literally the definition of impressive operational leverage. Let's move on to section 3, dominating strategic market segments.
This is where we see their strategy really shine. Right now, a lot of legacy sectors, think automotive or consumer packaged goods, are facing delays in large capital investments because of broader global uncertainty. But instead of just stalling out, Rockwell is aggressively pivoting toward hyper-growth strategic sectors to keep their momentum rolling. Just look at the sheer scale of these growth spikes. While the broader discrete market grew in the mid-teens, their e-commerce and warehouse automation segment surged over 30%. And data centers? Wow. Sales more than doubled year over year, growing over 100%. This proves without a doubt that their expansion into next-gen infrastructure is paying off handsomely and giving them a massive buffer against traditional industrial cycles.
And why does this matter to us? Because it shows exactly how Rockwell is cashing in on the AI-driven data center boom. These massive new facilities need extreme speed to capacity, unbelievable power resilience, and complex energy optimization. Rockwell is stepping right in and securing major wins with companies that are actively upgrading from basic commercial controls to Rockwell's super robust, industrial-grade programmable logic controllers.
which perfectly sets up Section 4, Software and Intelligent Devices.
CEO Blake Morit made a fantastic point about this on the call. He noted that their financial success is entirely grounded in tangible technological superiority. Thanks to some really smart strategic investments they've made over the last half dozen years or so, they've built a remarkably agile development environment. I mean, they can now incorporate AI capabilities into their cloud-native software within months of the initial release. That speed is a game changer.
So what does this actually look like in the real world? Well, we've got ATS Automation using Rockwell to power a massive new AI data center in Texas. Subaru is out there deploying Rockwell's autonomous mobile robots to scale up production and boost safety, and Promethean Tire Group is using their cloud-native FIX software for digital maintenance all across their global sites. These kinds of mission-critical deployments are exactly how you build a resilient business model, one that, by the way, recently reported over 6% growth in annual recurring revenue, heavily led by their software segment.
Finally, that brings us to Section 5, the upgraded fiscal year 26 outlook.
Thanks to that stellar volume and very strong conversion we just talked about, Rockwell delivered what we call a classic beat and raise. They significantly upgraded their key metrics for the full year. They pushed their enterprise operating margin outlook from about 20% all the way up to roughly 21.5%. They raised their adjusted EPS midpoint to about $12.80. And they did all of this while expecting organic sales growth in the 5% to 9% range, all while maintaining a free cash flow conversion of around 100%. And believe me, Wall Street is definitely paying attention to these underlying fundamentals. You've got analyst firms like D.A. Davidson setting an ambitious $500 price target for the stock. This kind of optimism is built directly on that exact operational leverage we've been unpacking, their proving ability to expand margins, integrate AI rapidly, and pivot to the fastest-growing sectors of the economy. So as we wrap up this explainer, I want to leave you with this to chew on. Given their unbelievable ability to expand margins, manage their costs, and capture massive secular megatrends like AI, just how high is the ceiling for this company? Are we potentially looking at one of the defining industrial automation plays of the decade? Thanks for joining me on this deep dive, and as always, keep your eyes on the numbers.